If you are buying a home in Canada or thinking about it, understanding how mortgages actually work will save you time, stress, and money. I am a mortgage agent, and in this video, I am walking you through Mortgage 101. What a mortgage is, the key terms, the different types of mortgages available, and actual process from start to finish. Let's start with absolute basic. Let's define what mortgage is. A mortgage is a loan that is secured against real estate. It's a tool that allows you to buy a home without having to save up for a full purchase price, which, let's be honest, would take most Canadians literally decades. Here how it works. You put down payment, the bank lends you the rest of the money, and you pay them back over the time some interest. If you ever had a car loan or a student loan, you know those are set up so that you pay them off complete by the end of the term. But with the mortgages, they are not set up that way initially. So mortgages are split into two pieces. There is amortization, the total life of your whole mortgage, usually in between 25 and 30 years, and the term, which is basically the length of your specific contract with the lender. So usually that contract is in between 1 to 5 years. So you might have 5-year fixed mortgage on 25 years amortization. That means your payments are calculated as if you are paying the mortgage over 25 years, but the interest rate is only locked for 5 years. So you ask what happens after those 5 years. After those 5 years, you renew at whatever current rate are. This is the number one thing that confuses Canadians constantly. Your mortgage is not 25-year contract. It's a series of shorter contracts that you renew every few years. Understanding this is absolutely critical because it affects everything else we are going to talk about from now on. Okay, now let's talk about the key mortgage term, amortization. So what is amortization? This is the total time that it takes to pay off your whole mortgage. So in Canada, if you are putting less than 20% down payment, your maximum amortization can be 25 years. And it depends if you are a first-time home buyer or not. If you are putting 20% or more, you can go with 30 years amortization. The shorter amortization means higher payment, but you also pay less interest over the whole mortgage. So the longer amortization means lower payment, but you pay more interest over time. Let's move to the next term. The next term is the length of your mortgage contract. Most Canadians choose a 5-year fixed, which is the most popular term. About 40 to 45% of all mortgages are 5-year fixed. We also have 3-year fixed, which is growing in popularity right now, or a 5-year variable for people betting the rate drop. And here is the key. Your term is not your amortization. Your term is just how long your rate is locked in. This is what trips people up. All right, let's move. The next term is principal. Principal is the amount you actually owe on your mortgage. As you make payments, your principal goes down. Okay, so next term is interest. Interest is what the bank charges you to borrow their money. So in Canada right now, rates are roughly in between 4 to 4.5 for 5-year fixed and 3.8 to 4.2 for a 5-year variable. Here is something that most people don't realize. At the beginning of your mortgage, most of your payments go to interest, not the principal. But over time, that flips. and the more your payment starts going towards the principal. That's why it feels like you are not making any progress, at least at the beginning, because most of the money that you are paying actually goes to the interest. Let's go to the next term. Open versus closed mortgage. A closed mortgage means you are locked for the same term. If you want to pay it off earlier, you will face a penalty. An open mortgage lets you to pay it off anytime without any penalties. But the interest rate is always much higher. It's actually higher in between 3 to 4% and even more. So most people should get a closed mortgage unless they know they're going to sell their home within a year and a half. To break even point is usually 18 to 24 months. All right. The next term, let's talk about fixed versus variable. And this is the big one, especially right now. A fixed rate means your interest stays the same for the entire term. Do you remember term 3 or 5 years? So it gives you the predictability and it's stable, no change through those years. Variable rate means your rate changes. So with the Bank of Canada prime rate, it can go up if the prime rate goes, or it can go down if the prime rate goes down. Right now in 2025, the banks of Canada expected to continue cutting rates. So variable rates are look more attractive than before. But if you want stability and predictability, especially if you're a first-time home buyer and you want to sleep at night, fixed rate is most probably the way to go. With variable rate, you can have actually two types of variable rate. There is adjustable payment, where your payment changes when the rate changes, or a fixed payment, when your payment stays the same, but your amortization changes. Be careful with this fixed payment on a variable. If your rates goes up, it could end up in negative amortization, where your payment does not even cover the interest at all. Okay, let's talk about extremely important part, and it's mortgage insurance. So here in Canada, if you're putting down less than 20%, you're required to get mortgage insurance. It usually comes through one of the three insurers: CMHC, Canada Mortgage and Housing Corporation, Sagen, and Canada Guaranteed. Here, what people get wrong: the insurance protects the lender, it does not protect you. If you default on your mortgage, the insurance pays the bank. You still lose your house. Here's how down payment works in Canada. You need 5% down on the first $500,000. You need 10% down on anything above $500,000 to $1.5 million. And 20% down if you want to avoid insurance altogether. So let me give you an example. So let's look at a realistic first-time homebuyer scenario, and the house is around $750,000. First $500,000 at 5% down, which is $25,000. Next, the $250,000, we need to put 10% down payment, which is another $2,500. So total down payment is $50,000. Now, the insurance premium gets added to your mortgage. On $750,000 purchase price with $50,000 down payment, your insurance premium would be around $28,000, which gets rolled into your mortgage. So your actual mortgage becomes $728,000 instead of $700,000. The news: insured mortgages actually get better interest rate, and because they are less riskier for the renter. So yes, you're paying one-time insurance premium, but you're also getting a lower rate. And sometimes that lower rate is quite significant and can be in between 0.2% to 0.4%. Okay, now the big question: how much do you actually need to qualify? So in Canada, lenders use what we call the stress test. This is what introduced in 2019, and it means you need to qualify at the rate that is higher than what you're actually paying. So right now the stress is greater. Number one, your contract rate plus 2% or 5.25%, the minimum qualified rate set by the regulators. So if you're getting a mortgage at 4.5%, you need to prove you can actually afford a payment at 6.5%. 4.5 plus 2%. This is a big deal because it significantly reduces how much you can qualify for and how much you can borrow. Lenders also look at two key debt ratio. The first one is GDS, gross debt service. So your housing cost, mortgage, taxes, heat, and condo fees, if a cannot exceed 39% of your gross income. And TDS, which is a total debt service, your housing cost plus all other debts, car loans, credit cards, student loans, those cannot exceed 44% of your gross income. Let's talk about HELOC, which is equity line of credit. A HELOC lets you borrow against your home equity. You usually make interest only. It is flexible. You can borrow and pay as needed. So HELOC usually used for renovations, paying off higher interest rate debts, or actually invest. HELOC usually have a little bit higher interest rate, which is prime plus 0.5%. Then we have advanceable mortgage. This combines a mortgage with home equity line of credit. As you pay down principal on your mortgage, your home equity line of credit limit increases. Popular products includes Manulife One and Scotia Steps. These are the best for people who want the flexibility and access to equity as they build it. Okay, so how do you actually get a mortgage in Canada? Here is the step-by-step process. Step number one, get pre-approved. Talk to a mortgage broker. They will review your income, your credit, and your down payment and tell you how much you can actually borrow. Make sure they actually review your documents. That's a super important step. Pre-approval includes income verification. We need to check your credit history and a down payment confirmation, not just quick estimation. Good pre-approval will give you a rate hold for the next 90 to 120 days, and it will protect you if the rate will go up. Number two, you start by hunting. Look for properties up to your pre-approval amount. Don't fall in love with the place you cannot afford. And remember, just because you got approved for $750,000 doesn't mean you should actually spend the whole amount. All right, so now we are going into step number three. Make an offer. Once your offer is accepted, your broker submits a full application to the lender. Now we are into step four. And that's where we'll get your approval and the commitment letter. So the lender reviews everything and issues a commitment letter. This outlines your rate, your term, your amortization, and any conditions you still need to meet. Conditions might include proof of home insurance, a property appraisal, and final employment verification. Step number 5. We are into closing. You meet with your lawyer, sign the mortgage documents, and transfers all the funds to your lawyer. You also need to pay some legal fees at around $2,000. You will of course have a land transfer taxes different by province. So in Ontario, it can be roughly in between 1.5% to 2.5% of your purchase price, plus a home inspection and a moving cost. And congratulations, you are a homeowner. So before we wrap, here are 3 quick tips from me to you for a first-time home buyers here in Canada. Tip number 1, use a home buyer's plan. You can withdraw up to $65,000 from your RRSP to use on your down payment tax-free. You just have to pay it back over the next 15 years. Tip number 2. Start improving your credit score before you apply. A score above 700 will get you the best rate. Pay down your credit. Please don't miss your payments, and don't apply for any new credit cards right before you get a mortgage. And tip number 3, work with a mortgage broker, not just your bank. Brokers have access to more than 30 plus lenders, including banks, credit unions, and alternative lenders. Banks only offer their one specific product. More options usually mean a better overall fit for your specific situation. Thank you so much for joining me on my channel today. If you found this helpful, hit that like button, drop a comment below, and subscribe so you don't miss future videos. If you're looking for mortgage financing anywhere in Canada, I will be more than happy to help you. Thanks for watching, and see you in the next video.